All right, students, I ended the video talking about bonds. Let's pick back up there. So here on page 457, you see they talk about bond selling at a premium or a discount. Now, when we record the bonds, we do record the premium or the discount. A premium is the amount by which the bond issue price exceeds its face value. So if its face value is $1,000 and it sells for $1,050, then the premium is $50, the amount of the sales price that exceeds the face amount. Now, discount, the amount by which a bond's issue price is less than its face value. By the same token, if that $1,000 bond sells for $925, then we would have a $75 discount. Now, again, that premium or discount is really just an adjustment in the interest rate. So, how do we record bonds when they're sold or issued? Well, if they're issued at face value, it's really simple. We have $100,000 of bonds. We sell them at face value. So $1,000 each for the 100 bonds, that's $100,000. We debit cash because we receive cash. We increase cash. Debit cash, credit bonds payable, which is a liability, increasing the liability. Now, if bonds are issued at a premium, the premium, you'll notice I've written it in here for you so you'll understand. The premium on bonds payable is going to come into play. Now, premium on bonds payable is what's called an adjunct account. It's an adjunct liability account in this case because it's associated with bonds payable, which is a liability. So it's an adjunct account, an adjunct liability, a supplemental liability, or a supplement liability. So referred to under all of those names. But in this case, we issue the bonds for $107,260. So issued at 107.26 is the way it's often mentioned right up here. That means 107.26% of the face value. So we're going to issue them for that. So that's the amount of cash we're going to receive. So we debit cash for that amount. Credit bonds payable at face amount, right down here. And then we record the premium on bonds payable, which is a liability, and it's credited. So now as we make interest payments, we're going to take a portion of this premium and reduce it. So when we pay an interest or pay a interest payment, so we have $100,000 of bonds face amount right here, and it's 6% interest, so that would be 3% for each interest payment, semi-annual interest payments. So we're going to pay $3,000 cash. Now, let's say that the bond's term is 20 years. Well, we would divide this if we're amortizing it on a straight line basis, which is the only thing I teach you in here. It's really not permissible by GAAP, but it is simpler. So we divide the premium amount by 20 years. That would give us $363 per year of amortization of the premium. So we're going to credit cash for the $3,000 paid. We're going to debit premium on bonds payable for 1/20th of this, $363, and then debit interest expense for the difference, because what's happening with this premium is every time we make an interest payment, part of it is actually interest, and part of it is just refunding to the people that bought the bonds some of the money that they paid, represented by this premium. Because at the end of 20 years, if these are 20-year bonds, these people aren't going to get paid $107,260. They're going to get paid $100,000. So through those interest payments, we are refunding them this premium that they paid in, this amount that's greater than the face amount of the bonds. So you see down here, the discount works exactly the opposite. And they're not showing you a journal entry with amortization of the, oh yeah, there it is. I missed, no, that's not amortization of the premium, but that's how the amortization of the premium works. So then bonds issued at a discount is the opposite. We sell bonds, $100,000 face value bonds for $93,336. Well, basically at maturity, these people are going to get paid $100,000. So this difference of $6,624 is additional interest. Now, they're not going to get that in the semi-annual interest payments. Instead, they're going to get that whenever they are paid $100,000 at maturity. So the $6,624 less than the face amount of the bonds that is being collected in cash when the bonds are sold is a contra liability. It's called discount on bonds payable. It carries a debit balance and reduces the book value of the bonds payable. So there's the journal entry when we sell the bonds there. So we're going to debit cash for the amount of cash received, credit bonds payable at their face amount, and then debit discount on bonds payable for the difference in this case. Now, again, that discount on bonds payable is additional interest that the people are going to collect when the bonds mature. So as we make interest payments, interest expense will actually be higher than the amount of cash we pay in interest. We're paying $3,000 interest each interest payment period, but interest expense is going to be the $3,000 cash paid plus a portion of this discount that's amortized in that period. So again, if we assume 10-year maturity and or I think it said 20-year maturity, so we would have 40 in payments. So we would divide that by 40, and that would give us the amount of the amortization of the discount at each interest payment period. Okay, they get into a discussion. Why would we be willing to issue bonds at a discount? Well, it just has to do with the market interest rate versus the stated interest rate. Students sometimes ask me, well, why don't they just put the market interest rate on the bonds as a stated rate? Well, the reality is, before you issue bonds, you have to file a lot of paperwork with the SEC and with state regulators. And so they have to kind of guess at what interest rates are going to be at that future date when they're finally able to sell the bonds. So they may guess wrong. They may miss it by a little bit because interest rates change daily, and sometimes conditions are such that they change pretty fast by significant amount. So that's really the key driving factor, key driving force there. Okay. The market interest rate, the rate of interest that investors demand from the bond. And So I think I've covered all of that pretty well. There they get into interest expense and start explaining interest on the bonds. So here we get into interest on bonds issued at a premium. And I explained that a few minutes ago. But basically, the carrying amount of the bond goes from whatever it was sold at to face value over the life of the bonds. So we're amortizing this bond premium here, and that's reducing interest expense because because we have to get the carrying amount down to the face amount at the maturity of the bonds, because that's what's going to be paid back. And so at this amortization of the premium is going to reduce interest expense below the cash paid as interest payments. And so with a discount, it works the opposite way. Every interest payment period, we're paying so much in cash, but we're also adding to the carrying value of the bonds, so that at the maturity of the bonds, the carrying value will equal face value. So we're having to add amounts to it with the amortization of the discount. Okay. Now they get into retirement of bonds. Quite often bonds are what's called callable. And what that means is the issuer can actually just say, I want to go ahead and pay that off early. Now, usually they're only callable at interest payment periods. You have to pay them their interest payment, and then you can buy the bonds back, usually at an amount greater than the face value of the bonds. Usually when you call bonds, there is a loss involved. So when you retire bonds early, you call them, then your journal entries are pretty simple. You're going to remove everything associated with the bonds. So the bonds payable, any premium or discount associated with the bonds, you're going to remove. So you're going to debit bonds payable. You're going to debit any premium or credit any discount. And you're going to credit cash for the amount of cash you pay, and then any remaining amount you need to get the journal entry to balance out becomes a gain or a loss. Now, I've never seen a case where you had a gain on retirement of bonds. Usually, if they're callable, then the any premium they sell for will take that callable nature into account, and they will not sell for above the amount that they can be called for. So, but there you see bonds that were issued at face value are called for 102, which means 102% of their face value. So $100,000 in bonds are called at a bond price of 102. So 102% of $100,000 is 102,000. So that's how much cash we pay. Debit bonds payable for the face amount. There was no premium or discount in this case. So the difference, the $2,000 difference here, is debited because we need an additional debit to loss on bonds payable. If it were a credit, it would be a gain. Okay, they get into types of bonds here, and they talk about treasury bonds, munis, which is municipal bonds like the city of Wichita Falls. Midwestern State University would be classified as munis, even though we're not a municipality, but a government agency. And corporate bonds. And our time's about to run out. So I will pick up with explaining these on the next video.